Hello, my name is Perry Tepperson. I'm a CFA charter holder, also an actuary by profession. I work in the investment consulting business, advising a wide range of clients regarding investment strategy issues. Today we're going to talk about portfolio management theory with particular application towards developing investment policy for individual investors. Now we're going to kick it off with the portfolio management process, and I have a couple of slides that I can use to explain this in more detail. It's very important if you think about a building exercise. If you were going to be building a new apartment building, you would get in an architect, and the architect would sort of map out or scope out the steps needed, the design, the overall framework, and that design would follow some logical course. And during that process, there'd be an assessment of how things were going. You can think of portfolio management as a similar kind of a concept, that you're the architect now, thinking about exactly what factors to take into account in the construction of this portfolio, taking into account the needs of your customer, and having a logical framework to revisit and measure whether or not you've accomplished what you need to accomplish. So let's look at the slide here, portfolio management process. The first two elements are really the most important. Understanding what the objectives or goals of the investor are. I always use shorthand abbreviations. Feel free to use them as well if they help you in your studying, if they make things a little quicker, speed things up a little bit. Objectives, the goals that the investor has, and any constraints, any limitations or peculiarities, specific issues that might limit the investor. Then you have to take into account what the economy is doing. Is there anything in the economic environment that has an impact, that could influence the type of decisions you might make? Obviously, rates of return expectations come to mind. Then setting the investment policy setting the elements of the investment policy statement. The key component is asset allocation or asset mix, how the assets are allocated between equities and bonds, for example. That's the key because it drives most of the behavior of the portfolio. And then measuring whether or not it was a success. And there's a feedback loop here, going back to the beginning and revisiting. I'm going to use another slide as well, just to graphically show you in more of a flowchart kind of an approach, how this actually looks in practice. We've sort of just set the stage from a more simple perspective. Let's get into more mechanics of how this might look from a flowchart perspective, just in case in the exam they want you to come up with a flowchart or something like that. So let's move on to our second schematic, the flowchart approach of understanding investment policy setting. Again, it begins with personal related issues, what I call R&R, risk and return objectives and risk tolerance, risk preference. We also feed in more generic economic-related capital market expectations, the read on the economy, the read on expected rates of return. Building in the personal side with the general economic, more macro side, so sort of more micro and macro, you begin to develop strategy, advising your client, the individual, formulating an asset mix which drives most of the behavior of the portfolio, giving the investment managers their marching orders, and then what I call M&M, monitoring and measuring performance versus benchmarks. And that feeds back to the initial two in a dynamic way, what you might sort of refer to as a dynamic loop. There's no set fixed time as to how often you need to revisit. Typically, investors, both individuals and institutions alike, would revisit it on an annual basis, just doing a reality check, stepping back from the process, making sure that nothing unusual has changed. The fundamental assumptions are still appropriate. The interpretation of R&R, return objectives and risk preference, is still okay. The measurement is hitting the mark. The managers are performing in line with expectations. Or if not, what's causing the underperformance. And then a more thorough overview and perhaps even overhaul might occur every 3 to 5 years as needs change, as individuals, for example, move through their life cycle. Moving on to the objectives, again what I'm calling R&R, return objectives and risk preference. Let's start off with risk. For individuals, it's really their tolerance, their ability to tolerate risk, some of which might be behavioral in nature, in that some investors are just less willing than others to accept risk and absorb risk. They may even have an incorrect perception of their ability to tolerate. But that perception is important when you're going in advising and commenting on the individual. There may be some regulatory impediments, something, for example, in the trust, if there's a personal trust, which limits the ability to take risk. The willingness of the individual, their own view on, even if they can tolerate, are they actually willing? Sort of the old willing and able distinction. Are they willing to tolerate the kind of risk that they might, in theory, be able to? The financial strength is important. Is this portfolio a key part of their overall wealth, their overall asset base? If it is, that might suggest they're a little less tolerant of putting risk on the table. If it isn't, they may be more willing to absorb risk. What their spending needs are, the closer they are to retirement and the more they have significant spending requirements, the higher the need for, obviously, a stable income. And risk, obviously, might be defined differently. We may consider absolute volatility or the variability of returns. We might consider, in the case of equity mandates, a tracking error relative to benchmarks, and the willingness to hire an active manager, for example, to take that type of active risk. So that covers the risk side of the spectrum. Now getting on to the second component of the R&R, the rate of return requirements or expectations in respect to building the investment policy and the approach strategy. Really, we should distinguish between the return that the investor desires, what they actually want to accomplish, and the return that they require, that they absolutely have to have in order to meet their goals. There might be a conflict between these two. They might require a return of, say, 3% above inflation. They might desire a return of, say, 5% above inflation and want to take more risk to get there. In so doing, they might subject their base need to some risk. Well, they certainly will. They might subject it to more risk than they're really willing to tolerate. Return needs to be looked at in a total concept, both bringing in all of the factors, both income, capital, both realized and unrealized capital gains, blending all of these things together rather than looking at the subcomponents of return in silos. It's more appropriate to take a total return context. And also very important to consider return and risk simultaneously, because one cannot divorce the one from the other. Okay, if you want more return, you've got to take more risk. That's just the reality of the situation. So often counseling of the individual is necessary so that they understand that issue. Now, the next topic we're going to cover in terms of setting policy is the constraints that an investor faces. And we're going to go through, skip through, or step through each of them in a bit of detail. But what is important, and this is important for Level 3 in general, I mean, this is classic Level 3 material. You've got to remember this acronym. It's pretty straightforward. LTLTU. L, liquidity. T, time horizon. L, legal requirements. T, tax considerations. And U, unique preferences. So what you want to do is, just write this out, perhaps, or just say it to yourself a couple of mornings while you're making breakfast. Just remember LT, LTU, what they each stand for. And when you're setting investment policy, be it for individuals or other, you're going to look at all of these 5 subcomponents. And this is certainly going to come up in the exam, and you're going to be given a situation, and you're going to ask to analyze the situation and either develop policy or develop some subcomponents of the policy. You're going to certainly consider the R&R, the risk and the return, objectives and risk tolerance, etc. But you're also going to drill down into the constraints, and you're going to drill down into each of those 5, LT, LTU, individually and in some detail, so that you can demonstrate to the examiner a good understanding of the individual or the institution's situation, a good interpretation of it, and an appropriate commentary of how those constraints might feed into both strategy at a macro level and then selection of individual investments perhaps at a more micro level.